Good morning. Good morning. Find the clicker. It's great to be here in Sydney. I would love to have an open conversation as part of this as I share my observations and my experiences. I've been in this industry now for 4 years, and as the president of Prosper, have worked with a platform that's gone from $9 million a month in originations, peer-to-peer, to $425 million a month, back to 100, and back to 250. And I also have this unique opportunity as a personal investor in the equity or debt of 14 different lenders in the ecosystem. And so what I really want to do is share that experience. And as we know, that success in life is difficult, and it's complicated, and it's not a straight line. And that's what we witnessed in 2016. But I'm really going to focus on 2017. And there is an elephant in the room. There is an elephant in the industry, and we're going to talk about that. And this slide presentation will be available to anybody, so feel free to take pictures, but I'm also happy to share the presentation and answer questions at any time. I used to talk about the sharing economy in 2013 and 14, where we used to share pictures and music and videos and emails, and we moved to something called the access economy, where we started to be able to access each other in new ways and different ways. Think about Uber and Airbnb, how it changed transportation and lodging, and think about movies and music, how we now access those things so different than before. And that's really what we're all doing here in consumer lending, in student lending, in mortgages and real estate and small business, and now insurance is creating this access, an access economy to things we never could get to on our own. We always had an intermediary, but now what we're doing with money, with borrowing and lending, is part of this big wave, this big change. The millennials and the Gen X will not do money transfer, wealth management, borrowing and lending the old way, the way we did it. So let me tell a quick story and see if you can guess the answer. You all know the answer. And the analogy is about this. It's about something that was offline in our lives in 1985. It was something where some new players came into the industry. There was global growth in this industry, in this new way of doing business. And we saw volatility in the 90s and 2000 in this industry. And there was lots of hype, stock prices, the media, and then there was this whole shakeout with mergers and acquisitions in this industry. And now this is a dominant, resilient part of our lives. What am I referring to?
Mobile data.
Say it again?
Mobile data.
Mobile data. Excellent guess, but I'm talking about the online trading industry. How many people are old enough to remember calling somebody to buy or sell a stock? Or picking up a phone and typing in a bunch of numbers, or doing trading the old way. We take it for granted now that we can just go to our mobile device or a computer and buy or sell anything around the world. Equities, options, futures, gold, commodities. This was just a 35-year generational shift. And I argue that what we're doing here in this room, in this industry, is the same thing. It follows the same path. And what we saw in 2016 was our market turbulence, was our moment, the beginning of the shakeout, the beginning of the separation of the winners and the losers. And it's fascinating to see what the components are, and we'll talk about that in the 5 key things and the 3 takeaways. What is it that differentiates a winner and loser? The pack separating in our industry. So it's not a fad. People thought that streaming movies or streaming music was just a fad. And those are the people that still have lots of CDs and VHS cassettes of music and movies. It's really something that was here to stay. What we're building here isn't a trade. It's an asset class. It's a fixed income alternative asset class. And the search for yield, the search for money, both borrowers and the search for a return of the money and a return on your money is bigger than ever around the world. I literally was in Asia twice, the Middle East twice, and all around North America, Latin America. It's the same everywhere. People are looking for opportunity, both borrowers and both lenders. So at Prosper, we're focused on 4 things. I just want to share that. This is not a commercial about Prosper, but these are many of the common things that each platform is or should be or will be focused on. The risk model, it must change. This is a marketplace. We have to change rates, terms, and dollars. We unveiled the 7th generation of Prosper's risk model in December, and it enabled us to do more and better and bigger and different types of loans. And this iteration is something that gives us a unique opportunity as online lenders, some balance sheets, some marketplaces, some peer-to-peer, is the ability to develop this risk model. This is the chart everybody should be asking for. If you're an investor, a vendor, a bank, an accountant, a platform, what is the risk model visually? If you look at the FICO line, the gray line going from left to right, that's if you just lent on FICO. And these are the different generations of the Prosper Marketplace Inc. risk model. Again, PMI 7, look how we're moving up and to the left, trying to find more goods and turn away more bads. This is called the receiver operator chart. Ask for it. Every platform should have it across every segment: consumer, students, mortgage, real estate, small business. Verification and validation, major improvements in this industry. How many people with a quick show of hands know what shotgunning or stacking is? It's a major issue in America where the borrowers realized they could go to 5 different platforms, apply at the same time, get the money, and then not pay. And so we've created coalitions and data and integration with other lenders so we can see if one borrower is stacking or shotgunning. Stacking is borrowing many times, shotgunning is going to many. And we can now cancel these borrowers' requests before we give them the money as an industry. Really important that the ecosystem work together and we share data as an industry. Efficiency, growth, quality, and profitability. As David said, we must become profitable. We must generate cash and generate earnings as platforms, because the days of fear of missing out, FOMO, and the venture capitalists just throwing money at this industry aren't over, but it's different. You see platforms raising money today. SoFi, Credible, the Prospa here in Australia. There is money for platforms who can show efficient, quality, and path to profitability. And customer engagement. It's really all about this. How do we get to that borrower, to that business, to that person, and have that experience be one where they tell their friends and never go back to the old way? If you go to Facebook and look at My Prosper Story, you'll see 20,000 people who submitted a story, how we help them debt consolidate, home improvement, large purchase, medical, travel. It's a really powerful thing. And in the dark days of 2006, when people forgot why we were doing this, we referred them back to the customer stories to remind people of the good that we're doing. Some platforms didn't quite get risk right, and the platform provided loans that didn't perform as expected, as estimated, that the gross coupon wasn't high enough, that after the defaults, which came in higher than expected, and the service fees, the returns were negative or weren't there. This is what our returns look like. Again, this is fixed income, not equity. So even though we had all the changes, regulatory changes, interest rates, unemployment, Brexit, everything, the loans have to perform, as we say, in a risk-adjusted return with similar liquidity and similar duration. Again, 16 is over, here's 17. So for me, this is what we think about in the US and around the world as an industry. These are the 5 things that we must do as a group. When I got to Prosper in January of 2013, peer-to-peer, no institutions buying, no leverage, no rating agencies, no securitization. And we built out this ability that our clients, the investors, the institutions could buy whole loans. They could leverage the loans. We could get multiple rating agencies and create a shelf, a transparent shelf, a consistent one, that now pension funds, superannuation funds, endowments, banks, insurance companies could own the short duration credit that we deliver. We debated with Asia and with Europe, should this be part of our industry? As long as it's transparent and we have skin in the game and have risk retention and we're eating our cooking, the answer is absolutely. You'll see a $400 million plus securitization from Prosper in April. The demand is there. Institutions are looking for a different way to own our asset, and securitization is critical. But it has to be structured right. Regulation. We're SEC registered. We file prospectuses every single day, and we're state registered. In every state, we have borrowers and investors. We have banks who buy from us, so we have to work with FTC, CFPB, FDIC, you get the idea, OCC. We really have to have groups that focus on regulation, not just for the SEC, the government in the states, but for our institutions and banks who are buying from us as well. That's why I think that the industry, as we standardize data, it will make it much, much easier for us to welcome on new kinds of investors. And innovation, it's really innovation and agility, which is what is so unique about us. It's not that others can't also find the banks, the borrowers. It's not that the banks can't build the technology or build our risk. It's this whole ability to be agile and innovate that makes us unique. I think that you see lots of companies doing product expansion, going from consumer to real estate to business to mortgages. And you see geographic expansion. There was lots of talk and hype about this, but it's now about the reality of doing it and doing it efficiently and doing it profitably and getting borrowers and new acquisition channels. And it's this agility. When we have banks who bought equity in Prosper or banks who buy loans from us, they are amazed about our ability to be agile and adjust and change. And that's where we're working with banks to share what we've done, to show them the value in working with us. And then again, expansion. It's got to be done right. We can't make all these press releases and announcements without execution. And that's where I think lots of platforms in the industry got ahead of itself or over its skis last year. It's about expansion, but doing it in the right way, products and geography. So I used to show this chart, and all the banks would be on the chart. But now we see that banks are here in the room. And we welcome the banks to understand what we're doing and how we're doing it. That our competition as an industry isn't against the banks. It's about what Rob said. It's about education, awareness, and understanding. That's our competition. It's explaining to people what we do. So I'll give you a preview to my presentation to 5,000 people at the Javits Center on Monday about the 5 things, the 5 Legos, the 5 building blocks that we're doing as an industry with the banks. The first one is banks are buying our loans. They need short duration assets. They need credit for the balance sheet. They have all the low cost of capital, and so banks are buying loans from us. Usually the top of the stack, the AA's, A's, and B's, or the A, B's, and C's. So the second thing the banks are doing is they're leveraging our loans and securitizing our loans. The third thing we're doing with the banks is we're doing white labels, or lending as a service, LAAS, where we're enabling banks to take their front end, connect to us with a software development kit, SDK, provide the credit risk pricing underwriting. They can service or we can, and they can fund it, or it can go out into the marketplace. So it's that kind of interesting hybrid model. The fourth one is mergers and acquisitions. Will we see banks buy the profitable, as David said, platforms? Or number 5, will we see banks build it themselves? Put up hundreds of millions of dollars, take years and years and hundreds of people to build it themselves. These are the 5 things that we're talking about with almost every bank. It's not just the innovation center of the bank coming to us, it's the top of the house. The credit team, the consumer team, the CEOs. As you see banks enter this business, like Goldman Sachs, the number of incoming calls from every other bank is escalating by the day. What are we doing? So when the next investment bank or bank around the world says, we're doing this too, you'll start seeing in the boardrooms the tables being pounded from the rest of the banks. What are the ways we're doing it? Which of the 5 things are we doing, and which platforms are we connecting to? To me, this is the elephant in the room. We're all already talking about what are the 1 to 5 ways to work together. So for me, success in 2017, it's all about loan performance. If we give out money at the wrong rate, the wrong dollars, the wrong term or duration, the investors will go away. You've seen it in the US. We've had the collapse of a few platforms who missed, who wanted to grow, who wanted to raise money or go public or be public and have the pressure to bring on a bunch of borrowers, but the loan performance wasn't there. That's a short-term game. It's not going to work. As marketplaces, we have to adjust. At Prosper today, the net return on a forward estimated basis is 7.9%. That's down from 10 3 years ago, but up from 6.25 just a year ago. And we've had to adjust and be agile in loan performance to make sure we have something called equilibrium, which is the same number of borrowers and the same number of investors. And those investors get to look around at every other fixed income instrument with similar risk and duration and liquidity to see if they want to own what we're manufacturing. It is about data transparency. This ecosystem is critical. We are announcing our partnership with AltFi. We think it is critical that they have our data. They're able to visualize and articulate what they see in what we do on an absolute basis and a relative basis to all the other lenders. We think this is absolutely critical. Platforms who aren't going to share with AltFi, red flag. Why not? Why don't you want them to tell you their view of what we're doing? We're very, very much in support of what AltFi is doing. That's confidential. We haven't announced it yet, but we should be today or tomorrow. And again, profitability. Some platforms don't make money at $500 million in loan originations a month, and they're burning millions of dollars of capital, going back to venture capitalists who are like, without this path to profitability, it's not going to happen. So at Prosper, we've had to right-size the company, remove the shiny objects, those projects that we were working on that will never generate cash, that were cool, but not critical. Nice to have, not needs to have. We, as an industry, are democratizing capital. We're removing people from needing to do that. Walk into a bank, call your trader. We're doing it in a different way. We're doing it with these mobile experiences, with apps in the App Store. And this next generation truly is not going back to the old way. We've done so many conversations with people that are now starting to have income and have wealth and looking to invest their money and borrow money. So for us, this is part of the cycle of innovation. How many people remember in 2013 when Boeing, the largest aircraft company, had fires and smoke from the Dreamliner? The batteries weren't quite right. It affected the whole industry, the supply chain. Nobody wanted to buy the plane, lease the plane, ride on the plane, build the plane. That whole industry had to get together and talk about trust and transparency and recreate the whole business, the whole transportation cycle, so that the news cycle would change, so that the reporters would change, the stock price would change, and more importantly, the smoke went away. And that's what we're doing as an industry. We are rebuilding after our turbulent 2016. And so for me, there's never been a more exciting time to be in this room, in this industry, whether you're an investor or a platform or part of the ecosystem. Thank you very much.
Rob, we've already got some good questions here, actually. I'll bunch a couple of them up here so that we can shoot through them. First question. Ron, is the American market really ready for more securitization after the lending club events of last year, shall we put it?
So one of the things that the American market has done is we've created something called eOriginal. And what eOriginal has done is it's created a digital data vault at the very beginning of the loan, so that the big platforms, whether you're balance sheet or peer-to-peer or hybrid, when you do a loan, it goes in a digital vault. And it's got a fingerprint on it, and you cannot change that. So the buyer of the loan, the leverage provider of the loan, the securitizer of the loan, and the secondary market, you now know exactly what that loan was, and you can see if it's been opened or altered.
It's kind of blockchain of...
It's right before blockchain.
Yeah.
So we were talking last night with some groups in blockchain and in Ethereum how we do this even more. But I think we've learned lessons as an industry, and you'll see things like eOriginal and AltFi adding trust and transparency and security and standardization so that there aren't any new things with data like that.
Lending as a service, doesn't that represent a commoditization of marketplace lending services? How do you build a valuable business when you're just competing on cost? Because that's always a challenge for white label, isn't it? It is that you spend a lot of money building your brand, and then you basically pass the low-cost version out via the white label, and a lot of people always go, but that destroys the main brand. How does that work?
And so that's the stress or the tension in the 5 things with banks. So when we had banks invest in our equity, we had banks buy our loans, they all want us to try to find the data, to find the cultural fit with the bank, to find the technology integration so that they too can have it. And you see it with Uber and Airbnb, they're powering other kind of competitive ecosystems. Some platforms say, we're only doing 4 of the 5. We're not going to do private label, white label, private marketplace lending as a service. You have to buy us or build it. But at Prosper, we've made it very open to many banks that we've been able to connect to them, let them keep the brand, create their own risk model using our technology. They can do the servicing or we can, and they can buy all the loans or not. It's really a decision if you want to be open to 5 ways or 4 ways in working with the banks.
Last question here, Ron. Actually, a really good question from Harry. The recent surge in bond yields has made this search for yield not as hard as before. How does the industry navigate the funding cost headwind? I think there are 2 questions sort of built in there, aren't there? Because the first question is, as yields on some traditional corporates have gone up, actually that very traditional form of corporate bond looks quite attractive. You can get 3 or 4%, whereas you couldn't before. So suddenly that forces you guys to move up the risk curve, does it? And I think the second part of that question is, as that cost of funding has increased, has that then impacted you? So there's 2 parts to that question, yeah.
Yeah, so absolutely. Every marketplace has to find that point of equilibrium. How many people have clicked on Uber and you've seen a surge pricing? Well, they're just out of equilibrium. They have more passengers and less cars. And that's the same for us. If we have more borrowers and less investors, it means that our pricing is off, that the clearing price is off. And so we have to then change rates or change different pieces of the equation to come back to equilibrium where there's no surge pricing. You saw tremendous disequilibrium because the investors went away after the Mother's Day massacre last year, and we had to resize the market. Some people did discounted servicing deals or discount loans to par to come back to equilibrium. I mentioned it briefly. Last year, the net return after fees and defaults was 6.25%, and it's now 7.9%. So we have been raising rates, raising the coupon to the borrowers, and improving our pricing, credit, and risk to get to that 7.9, which is equilibrium today.
Just a quick follow-on from there. There's a sensible consensus out there that the Fed may raise interest rates by another, say, 50 basis points over the next year, maybe. Some people say more, some people say less. But let's just say 50 basis points. If that happened, what effect do you think, looking forward, it will have on your yields?
So half of our borrowers are doing debt consolidation, and half are doing large purchase considered purchase. So think about that $900 billion of outstanding revolving U.S. consumer credit that's pegged to the Fed and Treasury LIBOR rates. As the Fed rate goes up, credit card rates go up, which means that borrowers are now paying more, that the VIG or the variance between that rate and our rate is different. So the more rates go up, the more credit card rates go up, the more people come to online lenders who have lower cost of capital where we're not pegged to the Fed and Treasury. So for us, people said when rates were going down, great, but we'd never make it through an economic cycle, an unemployment change, or interest rate changes. And what we're proving to the non-believers and some of the haters is that we can be agile. We can go with changes in the economy and changes in interest rates. So for us, I think business goes up. And on the political front, you see in the US the new administration wants the government out of student lending, which creates all these opportunities for the SoFis and the Credibles and the other groups working with students in the US on the $1.4 trillion student debt issue.
So is that an area we expect you to get into?
We have no announcements about that today.
Should have yet. I think we've run out of time, but I know Ron's going to hang around for a while, and he's always very open to taking questions, so do grab him at the coffee break.
Yes.
But in the meantime, I'd like to thank Ron for coming on. Great speech. Thank you very much.
Thank you so much.
Thank you.